Anyway, look, thank you everybody, and as everybody has said, it's great to be here sort of in person. I recognise some faces, some new faces here, so my intention over the next 20 minutes is to get you guys to join us on our journey as we continue to take Mercia forwards. As you're having these circulated, you can at your leisure read 4 or 5 disclaimer notices, so I shan't add to that. So for those that don't know, obviously Mark Payton, Chief Exec, co-founder of Mercia, something like 20 years investment experience, commercialising tech, worked at the tech transfer in Oxford many years ago, spun out a number of businesses there. And also, to stay close really to the game, I also have a number of portfolio companies. One of them I was sitting on the board with, took it from the beginning all the way up to sale, was Oxgene, and we'll talk a little bit about that later on. Martin.
Yes, very briefly, good evening. So Mark founded the company and I was employee number 7, and we're up to about 120 people or so now. So it's been a really interesting journey, and it is good to be back presenting again.
Yeah, wonderful.
Thank you.
And I love this slide because it was 2.5 years ago that we presented here, and actually it was with Burford. So we were presenting up here with Burford. And just looking at this first, we presented our results last time, so turning over about 10 million for the full year. Their adjusted profit, we're losing money. I remember standing here saying we're going to move to a profitable business. Talk about that one in a moment. After tax, so you'll hear about the model we combine, and not too dissimilar actually to what Burford were talking about. We have managed funds and we have proprietary capital. And obviously the big swing comes from proprietary capital when you're getting realised benefit and fair value movements. 2.6 million profit after tax there. Net assets 126 million. Assets under management, just about $500 million, so 500 million. Go forwards 2.5 years, so there's COVID where we all cry in our lap a little bit. So go past the COVID bit, on to now the 6 months to our interims, 30th of September 2021. Turnover about 10 million, so basically the same as the full year 2.5 years ago. Profit, so this is operating profit. So this is the fund management business, the cash generative fund management business has now moved from a loss of just under $1 million to 2.4 million adjusted operating profit, so real cash there. In that respect. 6 months in terms of our profit after tax, 11.2 million. For those of you that are shareholders, you'll have been following some good positive news for Adyen sale, Endreams, etc. I'll talk to those in a moment. Net assets continue to rise, and assets under management gone from $500 million to nearly $1 billion. So a real journey, a very positive journey as momentum continues to build actually in Mercia. Last year, we stated what we called our 2020 vision, and that is growing assets under management by 20% per annum on average over 3 years. So we're coming up to the first year of that. And then 20 million profit before tax per annum, again, averaged over 3 years. It's really important because actually what that's really driving are the 2 metrics that we're here to deliver, Martin and I. And actually Peter Dine's at the back. Now Peter sits across our EIS and VCT business, so please do grab Peter afterwards. We'll be around for questions if you want to talk to us later. But what this business is doing is growing what we call a progressive dividend. So that previous slide we talked about no dividend back when we were here before. We're now 0.3 pence per share at the interim period as the dividend continues to grow for the business because we're generating cash to service that. And of course, grow NAV per share. That's delivered predominantly through our proprietary investment activity, and that's the capital growth in the business. So yield, capital growth. And it's a relatively straightforward business model, which I shouldn't really say, which is simply find value, add value, and realise value. Fundamentally, we're here to make money from what we do. So how do we find value? We are there in terms of deal origination. We see something like, so this is for the 6-month period to the 30th of September, saw over 1,000 business plans. That's because we're embedded in the regions. We have a very strong track record here of delivering value to our managers, founders of our portfolio companies, so they come back, repeat as serial entrepreneurs in that regard. We looked at, we invested in 74 companies, 38 new to the portfolio. You'll see in a moment we have over 400 companies now across the Mercia portfolio, and we're continuing to build that. And then in terms of add value, what we do is we look at our portfolio companies as they come through, and we have centralised resources. One of them is a thing we call Mercia Nucleus, which is a portfolio resource. We will put in board members, we'll put in senior management to the portfolio at our cost. not at the portfolio company's cost, but at our cost. And that then accelerates and drives value within those businesses, and we're very much part of that business, supporting them through. And then realise value. So in this 6-month period, 9 profitable exits, and I'll talk to a number of those in a moment. Very clear and addressable market. We focus predominantly in small to medium-sized enterprises, SMEs, sort of micro-cap, small-cap businesses, which are predominantly private. And those businesses are typically looking for something like 300,000 to 10 million investment from us, and in a sort of total need of 20 million. And the reason why that's really important to look for those businesses that are quite modest in terms of their capital needs, and this is predominantly venture, so that sounds good, is that our regional businesses typically don't need very much money to deliver value and grow value. That's a first point. Second point is it's a cyclical game here. So if you have what we call a syndication risk, so your syndicate investors move away from you, we can actually shoulder and support those businesses. So we can look after those businesses and grow value where it is. And typically we're selling these businesses between enterprise values of between 20 million and 200 million. Of the market, we invested about 100 million. We think that market is about 100 million. We think looking to this next financial year coming, we think that's going to grow more like 120, 130. So that market is growing, that addressable market, and we've only got less than 5% of that. So why are you a domestic investor only? Because that's what we do. We do domestic investment only, is because it's a sizable, addressable, growing market, and that works really well for us. So that was all the chipper stuff. This is not so chipper, and the reason why it's not so chipper, we presented this slide, but it said 65% here, so 2.5 years ago. And what this is the total venture capital, okay, invested across the UK. 70% of all the venture capital in the UK is invested in London. When I presented this before, it was 65%, so it's got worse. So this levelling up piece hasn't quite worked its through the system yet. Down at the bottom here, 25%. These are high growth businesses. So those high growth businesses that investors are looking for, there's 25% of those in London. So this is really at the heart of our business model, is that we see a disproportionate opportunity and a lack of competition out in the regions. And this, which I think because of Brexit we've lost the outline. But this is the UK over here. You can see that our offices and our presence are across the regions. We exclusively focus on the regions in that regard. In terms of exits, what's quite interesting, because you'll often hear IPOs, it's all about IPOs. Actually, for us, it's mainly secondary and trade sales. So that's where we see the opportunity in terms of realising value. Secondary is really important because this wall of capital that many of you will be aware that sits out there in private equity and venture is now buying positions by taking secondary positions, by taking people like us, Mercia Holdings, out of the equation. And again, I'll talk to the exits we've had in the last 6-month period that really brings that to life, actually. Our piece of cheese, as we often refer to it, so we floated in December 2014, and this was pretty much the same slide as it was then. This is a model we truly believed in back then, and now, as the numbers say, it's delivering. And what this is that we have our third-party capital, which is the light blue part of that. That's managing other people's money. That's about 760 million of our circa billion under management is third-party capital. And that supports businesses coming through. And then our proprietary capital, our balance sheet, is where we co-invest with businesses that are developing through here. All of the businesses on our proprietary capital, on our balance sheet, we've either co-invested with the funds or have come through in the funds in that regard. And the only other use of our proprietary capital is we actually are, on a selective basis, a limited partner and investor in the funds that we manage as well. We hold businesses on the balance sheet for typically 3 to 7 years. That's something that's very key to us. So part of the selection from here to there is to have some degree of confidence that that's when we will realise our investments from them. And this is quite important because it shows the sector focus of the balance sheet. But also around in this sort of pinkish colour is what we call the shadow portfolio. So these are businesses that we're tracking in our managed funds, and that's circa 760 million. We're tracking those. And actually we manage private equity, we manage debt. Majority is venture, but a business, Soccer Manager. So Soccer Manager came through our debt funds. So all of our funds are actually developing portfolio that could be pertinent and relevant to our balance sheet. They're split very nicely across the 4 sectors that we focus on. They're also split very nicely in terms of diversification, in terms of stage of the business, young business as well as rapidly growing businesses. And back in 6 months ago, we had Forensic Analytics and Pimberley there, which were in the shadow portfolio. They've now joined the balance sheet because we are having to build the balance sheet quite aggressively because we're selling quite well off the balance sheet. So we have to keep that portfolio growing. Martin.
Thanks, Mark. Thank you. These are slightly drier slides, I'm afraid, than Mark's more exciting ones. But as Mark's already said, we've been on quite a journey in the last couple of years since we were here. And this, I've just provided a little bit more colour on those 6-month results that we announced in December. It was a pretty strong revenue increase over the period. And of that sort of 10.1 million, 96% of that comes from our fund management operations now, which is sort of one side of our business. And also 86% roughly of that revenue is contracted and recurring. So it's a really solid, sticky revenue base. And because we are the fund manager, we basically self-bill for the majority of that income. And that means that our credit risk in that revenue is also extremely low. You can see there the strong growth in adjusted operating profit. But in addition to those headline numbers, we also received performance fees from the VCTs that we manage because of the strong performance of those 3 VCTs. So the profit after tax increased to 11 million from 8.2 million a year before, which itself was a pretty strong result. And you can see there how much our net assets have grown. And of course, these numbers are to September last year, and we've announced in January we announced the sale of Faradion with a big realised gain, which will add to that net asset figure. And then, of course, last week we announced the big Endreams investment, third-party investment, which again will add significantly to that net asset figure at our year end, which of course was last week. So at the end of September, net assets were 42.4 pence. And again, you can see there the growth in net assets, which is probably the closest correlation to our share price rather than something like EPS. At the half year, we had 52 million of cash. We've got no debt in the business at all. We've invested strongly into the balance sheet portfolio in the second half, but notwithstanding that, we're now sitting at the year end at just over 60 million pounds in cash. So it's a fantastically strong business now. And when we came to the market, Mark and I came to the market back in 2014, so the objectives was to build a balance sheet portfolio, to build a fund management business, to evergreen the balance sheet so we wouldn't have to come back to shareholders to keep asking for more money. We don't need to do that anymore. We are now dividend paying as well. So all of those early objectives, it's taken a while, but we've finally got there. And we're, as I said, as Mark said, we're dividend paying now. And we're not trying to lock ourselves into a cover ratio or something because we're still early in our journey. But we'd certainly like to reward shareholders with something like a 2% yield. So one half of our businesses really is our balance sheet portfolio, which Mark will touch on one or two of these in a moment. And it's maturing rapidly now. Some of these businesses have been with us since the beginning, say over 7 years ago. And again, also as Mark said, since the half year, we sold Faradion, an incredible business. We sold that for £100 million in total. So there's some fantastic progress now as these businesses mature. You can see there, we started that half-year period with 96 million of value. We invested 5.4 during the period, and we had 8.7 of overall fair value movements. And the other side of our business, of course, is our fund management operations, where we're managing other people's money, basically, including perhaps some of your own in terms of either our EIS or our VCT products. And I guess there's two points to make here about fund management, which is, how much money are you bringing in, and how are you performing with that money? And the acid test of that, of course, is your distributions back to your shareholders. And as you can see there, we had a very strong distribution period of 39 million going back to investors because of the success of our investing activities. So we finished the half year at just under 1 billion of total assets under management. And when we floated, we started with 23 million. Share register, briefly. We're very, for a relatively small, market cap about 150 million, we have I dare one say, a share register to die for, because you look at all these long respected holders here. So there's some great names here. And also, we do really appreciate that 10% of our register is yourselves. It's individual investors. And that's why we're so pleased about paying a dividend now, as well as the great growth in assets under management. So these are long holders, touching wood always, no hedge funds, and it is for a relatively still small young company. It's a great shareholder base. Thank you very much.
Excellent, thank you. What I should say is that what we do, because retail is actually very, very dear to us, because a lot of the capital we manage is retail capital as well, is that on our prelims and on our interims, on our first day of that coming out, one of the first presentations we give is through Investor Meet Company, which a number of you may be familiar with. We would encourage you to join us on that, because there's a great opportunity to ask us questions of the results, frankly, on the day of the results. So, as I said, I think our results are typically sort of first week or two in July, so please do look out for that. So just briefly about what's driving, if you like, the proprietary capital performance. And in large part, that's to do with the funds under management, but critically it's to do with the cash that you have on hand. So you need cash to both support existing portfolio as well as add new businesses to it. And what you can see with this unrestricted cash going across here is within venture, which is a regional and VCT EIS, tremendous amount of free cash. As with private equity, as with debt, as with our proprietary capital, and as Martin said, that's grown from that 52 million to over 60 million now. You can see the spread of portfolio, again, across the group and those different asset classes as well. So I think that just shows you the dynamic within Mercia, but importantly, the free cash to carry on growing the business as we are doing at the moment. I mentioned about the exits and how not all are IPOs here. So if you look at these are the exits we made in the 6-month period. Oddbox, that was a secondary, as was Snappy Shopper. So these are two that have come through secondary. We've had an exit for a secondary purchase going through on that one. Music Magpie was the only IPO. The rest are trade sales. In terms of our investment activity, if you exclude London, we're the second most active investor now. If you include London, we're the fourth most active investor. So Mercia as a group has grown substantially in terms of its impact, frankly, that we're having on the UK economy in terms of SME creation and support. I'm not going to delve too deeply, but I want to pick out from these two slides, which are, it should be our top 10, but we sold Faradian, so actually it's our top 9. But what's the important points to note in here is the percentage holding that we hold across these ones. We hold material amounts. Well, as Martin said, if you sell Faradian for 100 million and you own about a fifth of it, because actually the instruments we use usually give us a little bit more as well, then that's a material return in cash back to the balance sheet and to our funds. And I'll talk about that dynamic in terms of how we manage the potential conflict between funds and direct investment returns. You can see the diversity in terms of the sectors that we're operating in and the upward arrows in terms of their performance. And these continue to perform well in this second period as well. Again, you can see that sort of spread in terms of technologies, be it flat speakers, be it gaming, be it med tech, be it software, be it aluminium pressing. Real spread of technologies. The one thing that unites them all is a majority of those are based in the UK regions. So just a few short slides, and I'll just canter through these because these just talk about some of the case studies, which does bring it alive about what we're all trying to, the 120 people all facing in the same direction trying to achieve here at Mercia. So Oxgene was a business that we were very fortunate with to be right at the beginning of the journey here. And what they're looking at is, and this is very, very important when we think about the various recombinant vaccines that we've all been enjoying, is that one of the challenges with vaccines in particular, especially recombinant vaccines, they're expensive. So the cheaper you can make those, the more available they are to everybody. And that was really what was our heart of Oxgene, was biomanufacturing. Can you get these things down by 5 to 10 times, reduce that cost, therefore make it available to more? The answer, of course, according to Wuxi, was yes, because they bought them. But just to give you a bit of a journey here, we were working with, so Len Seymour is a serial entrepreneur. He's been in 3 of our businesses. We were working with Len and Ryan, who were the co-founders of this business back in 2011, made our first investment from our EIS funds in 2013. Balance sheet came in here in 2015 when the model was delivering, and that brought in quick scale-up capital. The reason why these founders like us is that there is a seamless transition from funds to balance sheet, and they get the money to grow their business. That carried on scaling across. We exited it almost this time last year, so just over a year ago. Because we owned 32%, this was £30 million that came back onto our balance sheet. At the time, we were holding this about 16 million. This was a 14 million profit on top of that when we sold this to the holding value that we had it in. And this brought back something like between 18 and 20 times back our EIS investment. So on a sort of IRR basis, it was 50% for the balance sheet, 50% for our funds. So nicely smoothed in terms of that regard. So it is all about the multiples and time, of course, with IRR. And that's the way we make sure that our funds and our balance sheet are being treated fairly for those participants that are in them. Faradium was a business we literally sold a few months ago. Another business sold for 100 million. So again, a nice opportunity here. Lithium batteries, we've heard a lot about lithium. Actually, this is sodium ion. 3/4 of the planet is covered in oceans and sodium chloride. So sodium is a very ready available element in that respect. This was a company that was, and like in many of our businesses we invest in, we call it enabling technologies. So we're not looking to set the world on fire here. We're trying to get things better, do things better. With this, we could use existing battery manufacturing capabilities, but swap in sodium and swap in cathode and anode technology in that respect, which is what Reliance loved about this business, and we sold this business to Reliance. But back to that journey, invested in it early on through our regional funds, this time venture funds. Come along to 2017, our balance sheet gets involved in that time. Our direct investment in Oxygen, we made 5 times our money from the direct investment. We made 4 times our money in Faradium, so quite comparable. 8 times for the funds return. And actually on an IRR basis, because this was quicker for us, it was about 70% for both the funds and the balance sheet. So again, nicely even. So again, you can look everybody in the face and say, nobody's taking advantage of anybody here. And then finally, because this was just literally a few days ago, but we made, so Endreams is our number one holding. And of course, the question that maybe you'll ask later on is, how confident are you in your holding values that you're booking down when you're putting your portfolio there? Well, this was actually a material fair value. This is a third party that's invested into this business. So again, on the time frame here, we were in it with our EIS investment. We came across with direct investment, and actually Ionic, which is the end there, the 20 million investment, we didn't invest anything. And because of the financial structure we had in that, when that converted out into equity, our equity holding remained roughly the same, so circa 30% still in that business. And back to the point on secondaries, we were able to sell our position out in EIS, which is great for our investors who are looking to reinvest that and get tax release, etc., because that's what we're trying to do here. Brilliant result for our EIS investors. So great journey across that 8 million fair value movement against our holding value. So again, we're holding these at the right price. People are coming along and buying them or investing them at higher value. So penultimate slide here, because we're an investor driven by purpose. We're in the regions, we're supporting businesses, frankly, that are typically unloved. We're delivering capital to those businesses and really support them to grow. And so ESG, purpose-led investment, is something really dear to us and our heart. We have an ESG team led by Jill. I'm on that. It says, this is wrong, because we had our meeting today. I report into Jill, definitely. But that is a really involved, and that goes through all parts of our business. So we have representation on all parts of our business on that ESG, from finance, Martin, all the way through to debt, private equity and venture. So it's great. It's a really, really engaged thing. We've pulled out some themes of the UN principles. We're driving those through. Actually, 2, net zero and diversity and inclusion, they are 2 major drives. The aim is we do it at Mercia. We've got over 400 companies. So if we do it at Mercia and set the example, we can then drive that through 400 companies and have a real impact in that regard. Was 106, now 120 people within Mercia. About 40% of the company women, over 30% in the investment team, and that is something we're continuing to drive. The financial services is very skewed towards a male-only industry. It shouldn't be, and we're spending a lot of time trying to address that. And then actually we had a What We Do Day back in December, and when people came in, we just asked them to describe Mercia with 1 word. And that was at the start of the day. And I really like putting this up, ambitious, friendly, fun, professional. These really do capture the spirit and heart of what we're building here at Mercia. So just in summary, what I haven't mentioned is actually when we last presented, a few months later, we bought 3 fund management contracts from the Northern Venture Capital VCTs, and those have come into the group fully integrated and delivering a fabulous acquisition. And we talked about the importance of culture. Culture is our, Martin has this very strict value driver analysis when we're looking at acquisitions. Half of our AUM has come through acquisitions so far, and culture is right at the top. If that doesn't work, then nothing else works. So culture, very good fit. And as I said, Peter at the back is driving that part of the business with EIS as well. Martin mentioned the contracted revenue. For those of you who are CFOs in the background, being able to sit down and look at next year and have confidence that 88% of your future revenue is contracted and recurring is a really nice place to be. And that is really at the heart of our Mercia's model as we keep adding funds and adding that progress going through. We have a 2% blended fee across what we do. So again, very compelling and strong. We've talked about the interim dividend growing up to nearly $1 billion now in AUM. As we said, sort of 23 million at the start is tremendous progress. A huge amount of dry powder across both the funds and the balance sheet, meaning that we can carry on doing these things without actually, especially with our balance sheet, without having to go back to the city to ask for more money. We have ample money to make acquisitions and to grow our own portfolio. The direct investment portfolios I've touched on is delivering. I mean, you can't dispute that. It's delivering, and it's delivering and maturing very, very well. And the final point, of course, is that there are, as we are still relatively small, but we're being noticed. And we're having more and more reports and reviews written against us. Canaccord and Singer's put a very detailed report out just recently, places up there in their sort of top 2 holdings of choice across the piece. So again, very flattering and something that we're trying to now deliver against that. Thank you very much for your attention.
Lovely. Okay. Terrific. Thank you very much. Questions for Mark? Questions for Martin? Big rush? I had a few. You mentioned the kind of levelling up agenda. Are you in any way a direct beneficiary? Is there any government money or are there schemes or are you able to capitalise on that?
So back in 2016, we acquired a business called Enterprise Ventures, which is a very strong business in the north of England. And after that acquisition, the first generation of regional funds came along. And we secured about 200 million, about 40% of those. So very, very good for us, actually, when you think about our funds under management being 760 million, quite a material part of that. The next generation of regional funds are coming out now. They'll be coming out this year. They are going to be much larger. So larger funds and actually an ability to deploy more capital. So we typically can write checks of up to about 2 million. The feeling is that's going to be more like 4 or 5 million. So much larger funds, much larger deployment targets, and that is to get money out into the regions because it still isn't travelling out there.
So what's the process for you to get the management of that money or to be involved in that process? How do you achieve that?
Well, so it'll be a competitive process, quite rightly so, actually, with public money. What will predicate it is track record in delivering, money to these businesses, supporting these businesses, and of course realising value, because ultimately the public sector wants its money back and more. So that's, track record's really important. Capability, are you out there in the regions in the first place? Do you have a physical presence? 120 people of us across the region, so physical presence is really, really important as well. And then there's basically that process of showing that you can deliver against your word. So if they can look at the first lot of regional funds that we're managing, and we can be judged on the output on that. And they have been, under our sort of management, have performed very, very well.
The other question I had was about private company valuation. How are the companies in the portfolio valued and at what frequency?
Yeah, I'll take that one. So the valuation methodologies typically are either the price of the last round, if there's a third party investing. There might be some commercial comparatives out there, some sector multiples which you can reference. It's a very early stage investment, your value at cost. And if you feel the business is not performing to its business plan, then you might take a provision and impair the carrying value of the asset. And we have one quoted company, and so you value that. We value that at every 6 months at the closing bid price. The change in the valuation rules a couple of years ago meant that you could no longer just choose one valuation methodology for each asset. So now we calibrate against several valuation methodologies for each of our carrying values of our investments. And also, even though we don't have to, as a listed company, we do have our half-year numbers reviewed by our auditors, BDO, as well as at the full year. So twice a year, we subject our own views on valuation, on fair value, to our auditors to scrub those numbers.
One more, if I may. We've seen a lot of international private equity coming in for kind of FTSE 100 companies or other large caps. Does that filter down in any way? Is there any kind of benefit at the level that you operate, or competition from more private equity money for the investments that you are taking part in?
I mean, two things. First thing I should say also on valuations, if our balance sheet assets that have go through exactly that process, we've never sold anything below the holding value. It's always been above the holding value. So that sort of validates it, I'd like to think. Yeah. And then in terms of, yes, there are large pools of capital out there, and this is creating two things. We're becoming the deal origination to them. So that's great. That takes syndication risk out because they are coming to us to invest alongside us. But the other thing is they're providing us with opportunities to exit. So that secondary market is really vibrant. So although the public IPO market has just cooled right down, the secondary market continues to go at a pace. So I see that capital not as competition, as either as an ally, as a syndicate, but more likely as an exit.
Okay, thank you. Any questions, please? Yes, sure.
How big is your due diligence team, and what's your average due diligence time frame and process? Is it sector specific, or how do you do that?
Yeah, so one of the biggest competitive advantages in our industry, and this is going to scare you all, is speed. So the bigger the team, the bigger the process, the bigger the outsourced, if you like, part to this, the slower you are and the more likely you are to lose the deal. By having the size of company and team that we have, the in-house expertise is tremendous. We also work with our portfolio. What we haven't mentioned, we've got 19 university partners, which also technical due diligence we can lean on as well. So we work within that community so that we can be fast and pacey. So we don't have a distinct team on due diligence. We have a central expertise, and we have systems, we use Slack, etc., that links everybody together on these things.